Welcome to the Deep Dive. We're here to cut through the noise of corporate earnings calls and really pull out the insights that matter.
That's the plan.
Today, we're digging into the results from that recent post-market close announcement. And let me tell you, this wasn't your average call.
No, it really wasn't. You just had to look at the market reaction the next day. This felt different.
Different how? Like more than just a typical earnings pop.
Oh, absolutely. This was a fundamental re-rating of the stock. You could feel the skepticism just evaporate.
Yeah.
Suddenly, there was this strong belief in management's execution.
Execution credibility.
Yeah.
And they really brought the visibility that people were looking for, hadn't they?
They did. It had been missing for a while, frankly. This call delivered that clarity.
All right, let's get into the numbers then, because honestly, they were kind of shocking.
Yeah.
The headline figures definitely set the tone. Where should we start? Top line, bottom line.
Let's hit the bottom line first. That EPS number really tells the story.
Okay. Non-GAAP EPS. So Wall Street was looking for something in the low 20s, right? Like 21, 22 cents a share.
Yeah, that was the consensus range. Pretty tight.
And they came in at 47 cents.
47.
I mean, that's a 124% beat over the consensus. When you see something like that, you have to wonder, was everyone's model just completely wrong, or did the company pull off something operationally massive?
Well, I think it's probably a bit of both, leaning towards the latter.
Yeah.
The models were built on, let's be honest, pretty deep skepticism about their ability to execute without friction.
Right, delays, cost overruns, that sort of thing.
Exactly. So this 47-cent number didn't just beat estimates, it kind of demolished them. It signaled that whatever operational issues investors were worried about, well, they seem to be fixing them systematically.
And critically, this wasn't just, some accounting trick to boost profits. The revenue backed it up too.
That's key. You need the top line support.
They reported $273.1 million in revenue. That was comfortably above the consensus estimate, which is around, $244 to $245 million?
Yeah, cleared it easily. And that's solid growth, too, about 9.9% year over year.
Okay, so strong EPS, strong revenue. But you mentioned visibility. Where did that come from? The order book.
Exactly. The order book is where you see the future demand taking shape. They posted record Q4 bookings, $341.5 million.
Wow, record bookings. That's the fuel for the future right there.
Definitely. And if you compare that to what they shipped.
The book-to-bill ratio.
Right. It came in at 1.25.
Okay, for listeners maybe not deep in A&D every day, what does 1.25 mean in simple terms? Good? Bad?
It's excellent. It means for every dollar of product or service they delivered in the quarter, they booked $1.25 of future work.
So they're refilling the pipeline faster than they're draining it.
Precisely. And seeing that strong ratio consistently, especially in Q4, gives you confidence. It all rolls up into their total backlog.
Which now stands at?
$1.40 billion. That's up 6% from last year.
So that backlog, that $1.4 billion, that's like a safety net for the margin story we need to talk about. It gives management room to maneuver.
Absolutely. They aren't just scrambling for work. They're working through a guaranteed pipeline. And that lets them focus on how they do the work, the efficiency, the profitability.
Which brings us squarely to the margins. This seems to be the core of the deep dive, the operational momentum.
This is where the real structural change seems to be happening, I think. Management went into detail on how they got there. Q4 gross margin approaching 31%.
31% gross margin?
Yeah.
Okay. And the drivers weren't just like higher volume?
No, they were very specific. They mentioned three things: better contract terms, more automation, and just streamlined operations overall. Active improvements, not passive benefits.
Okay, let's push back a bit here. We hear operational improvements all the time. Sometimes it just means they cut the coffee budget, How real is this? Especially improved contract terms. What does that actually mean on the ground? Is it sustainable?
That's the million-dollar question, isn't it? And yeah, the market was asking the same thing. What management seemed to convey effectively and what analysts bought into was a real shift.
A shift away from?
Away from some of those older, maybe poorly defined fixed price contracts that just carried too much risk if things went sideways. They're moving towards contracts with better risk sharing, and they're actually getting price adjustments, especially with their defense customers who really need their capabilities.
So it's not just raising prices across the board, it's smarter contracting, defining the scope and risk properly up front to lock in healthier margins.
Exactly. That feels more structural, more permanent than just a temporary cost cut.
Okay, that makes sense. And then you add the automation piece on top of that. Is that already flowing through?
It seems like it. It's helping drive that gross margin improvement. Automation, streamlining the workflow. It's taking cost out of actually delivering the product or service. And you see it flow down.
To adjusted EBITDA.
Yep. Adjusted EBITDA hit $51.3 million. That's an 18.8% margin for the quarter. That's a pretty strong signal that the efficiency gains are real.
And the cash followed. Free cash flow.
It did. Q4 free cash flow was strong at $34.0 million. And interestingly, they specifically tied this to focusing on reducing unbilled balances.
Okay. Unbilled balances. Let's pause on that jargon. What is that telling us?
Basically, it's work they've done, delivered, but haven't invoiced or collected cash for yet. In contracting businesses, high unbilled balances can tie up a lot of cash. It can signal inefficiency or complex contracts.
So management calling it out means they're serious about not just making profits, but actually collecting the cash faster. More financial discipline.
That's how I read it. It complements the operational story. First, fix the operations, then make sure the cash follows efficiently.
Okay, now let's talk about something that could seem contradictory. The pull forward. They accelerated some deliveries.
They did. About $30 million in revenue and roughly $15 million in adjusted EBITDA got pulled from future quarters into this one.
Normally, the market might worry about that. Like, are they just stealing from the future to make this quarter look good? Why wasn't that the reaction here?
Context is everything. If a company is struggling, a pull forward looks desperate. But here, given the whole narrative about fixing operations...
It looks like proof they can deliver faster.
Exactly. It was seen as validation. They said they were improving factory throughput, increasing capacity. Well, here's proof. They delivered early. It flipped from a negative signal to a positive one, showing strong demand meeting improved capability.
Right. Okay. So Q4 was the show me quarter. What about the tell me? What are they guiding for going forward? Let's look at FY26.
The guidance was interesting. For the full fiscal year 26, revenue growth is guided pretty conservatively low single digits.
Single digits, okay.
But and this is a big but, they specifically called out expecting an acceleration in the second half of the year.
That measured top-line guidance is really interesting when you put it next to their margin outlook, because the margin story sounds much more ambitious.
That's the key takeaway, I think. The margin guidance is where the revaluation story gets its legs. They're guiding for the full year adjusted EBITDA margin to get close to the mid-teens.
Approaching mid-teens for the full year, after hitting nearly 19% in Q4.
Well, Q4 had that pull forward benefit, remember? But yeah, approaching mid-teens for the full year is a significant step up. And they didn't stop there. They reiterated their longer-term goals.
Which are?
Low to mid 20% adjusted EBITDA margins eventually, and converting roughly half of that EBITDA into free cash flow.
So they're laying out a clear path. Here's where we are, here's the next step, here's the long-term destination. That gives investors something concrete to track.
Precisely. It makes the turnaround feel less like hope and more like a plan.
And the market clearly bought the plan.
Right.
Let's talk about that validation. The stock reaction was, well, pretty explosive.
It really was. You saw the stock close around, what, $53 and change before the call?
$53.58.
And the next day, it closed over $68.
$68.02. That's a huge jump. But more than the price, you look at the volume.
Absolutely massive volume. 3.17 million shares traded. Compare that to their average, maybe 720,000 shares a day.
So nearly 4.5 times the average volume. That's not just retail excitement. That's institutions repositioning. Big money deciding the story has changed.
Definitely. And you saw it in the options market too, right? Those near-term calls.
Yeah, the AUG 12 $55 calls, for instance. They went from maybe $2.50 before the call to like $11.50 after. Huge pop, validating that sudden bullishness.
And this isn't happening in a vacuum. The whole aerospace and defense sector has been pretty strong, hasn't it?
Very strong. That main sector ETF, you know the one, it's had a really good run year to date. So there are tailwinds helping here.
Right. That macro strength gives you more confidence in that $1.4 billion backlog. It feels durable. These aren't orders that are likely to get canceled tomorrow.
And the analysts followed suit pretty quickly, didn't they? We saw upgrades.
We did. Raymond James was a notable one. They didn't just nudge their rating. They went straight to strong buy and slapped an $80 price target on it.
$80. Okay. So if you put all these pieces together, the numbers, the guidance, the market reaction, the analyst calls, what's the big picture? What's the strategic narrative now?
It feels like a successful pivot. For a long time, this company was viewed through the lens of a painful turnaround. You know, cost resets, delivery delays, necessary maybe, but painful. And the valuation reflected that risk.
Yeah, a show-me story with a discount attached.
Exactly. Now, with this quarter, especially that near 31% gross margin and the clean beat, the narrative is shifting. It's becoming a story of demonstrable, profitable growth, supported by that solid backlog and strong execution. The market is paying up for that newfound credibility.
It's not a turnaround anymore. It's maybe a growth story, or at least a profitable execution story.
That's the reframing, and it's a powerful one.
Okay, that narrative shift is huge.
Okay.
Right, let's transition. Time for our This Is Not Financial Advice segment. We put on our imaginary hedge fund analyst hats, pitch an idea to the investment committee.
Okay, let's do it.
So the stock obviously had a massive re-rating, huge move. But as we discussed, management's actual revenue guidance for FY26 was pretty conservative, low single digits.
Right. So the trade probably shouldn't be based purely on expecting massive revenue beats. It feels like the leverage is really on the margin side.
A margin story, okay.
Yeah, the market clearly believes the operational turnaround is real now. But that guidance of approaching mid-teens EBITDA margin for the full year, given Q4's performance and those A&D tailwinds, it feels like there might be some conservatism baked in there.
So the thesis is, management might be under-promising on margins to over-deliver later. Sandbagging a bit?
Potentially, yeah. Or at least the path to even better margins might be faster than they're explicitly guiding. Think about those efficiency gains automation. Better contracts, maybe they gain momentum faster than projected.
So we're betting on an EBITDA margin beat, even if revenue just kind of lands within that guided range.
That's the core idea. If they can demonstrate a clear path, not just towards mid-teens, but maybe solidly into the mid-teens, say 16%, 17% by the end of FY26.
Then the current valuation might still look cheap, even after the big run-up.
Exactly. There could be significant upside left based on margin expansion alone.
Okay, so what's the trade structure? How do we pitch this?
Well, given the momentum, you probably want to maintain a core long position in the stock itself. Capture the general uplift from the operational recovery.
Standard long equity.
Got it. But to really juice the returns, if that margin story plays out faster or stronger than expected, you want some asymmetry. So you layer on something like an aggressive out-of-the-money call option.
Okay, targeting what kind of level? Maybe where the most bullish analysts are pointing, like that Raymond James $80 target.
Yeah, something like that. Buying, say, a longer-dated $80 strike call option, it's a bet that those internal efficiencies and the strong defense cycle really compound, driving EBITDA well past what's currently baked in.
So if they surprise on margins again, those OTM calls could have explosive upside. It leverages the gap between what might be operationally possible and what management is conservatively forecasting right now.
Precisely. It's a classic momentum plus margin expansion play. You use the option to get targeted exposure to the margin beat potential, limiting your capital at risk compared to just buying more stock.
Outrageous maybe, but plausible. Especially focusing on that gross margin improvement, if that truly is structural, it changes the whole equation.
I think that's the linchpin. Is that 31% gross margin figure or something close to it the new normal? If so, the path to much higher EBITDA margins is very credible.
Okay, let's wrap this up. Synthesizing everything. The huge market reaction seems justified, right? It boils down to what?
I'd say three things. 1, execution quality, they delivered. 2, a clean beat driven by real structural efficiency gains, not just pull forwards. And 3, a credible path forward for significant margin expansion backed by that strong backlog.
This quarter really seemed to give the market the proof it needed to believe the transformation story.
Agreed.
But there's always a but, isn't there? We talked about management focusing on reducing unbilled balances, getting that cash in the door faster.
Right, the working capital piece.
So here's a question for you, the listener, to think about. Can this company actually normalize its working capital, really brought down those unbilled receivables efficiently, while at the same time keeping up this pace of margin improvement?
Yeah, that's a great point. Improving operations is one thing. Managing the cash conversion cycle smoothly during a big shift is another. Sometimes that's where friction can reappear.
Especially when resources might be focused on the operational side. If they stumble on converting those growing sales into actual free cash flow, could that put a brake on the stock's momentum, even if margins look good on paper?
It absolutely could. Working capital can be the hidden snag. So yeah, keep a close eye on those unbilled balances and cash flow conversion in the coming quarters. That might be the next chapter in this story.
Definitely something to watch. Great insights today.
Thanks for having me. Always interesting to dig into these calls.
And as always, please remember, Everything we've discussed here, including that trade idea, is purely for informational and educational purposes. It is absolutely not investment advice. Do your own research. Happy tracking, everyone.